So it's Saturday, February 14th, 2026. And while, most of the world is probably thinking about Valentine's Day, last-minute reservations, that kind of thing, the global financial markets are waking up to a massive, massive hangover. We're not just looking at a few red charts. We're talking about a synchronized plunge. It started on Wall Street, rolled through Tokyo, and then just hammered Mumbai.
It's a complete bloodbath out there.
Isn't
I mean,
it?
if you're an investor, or even if your pension is just, exposed to the tech sector, you probably didn't sleep very well last night. The sheer velocity of it is what has everyone on edge.
And that is exactly what we're going to get into in this deep dive. We need to figure out why. Why now? We've got this really comprehensive report from Colt that connects all the dots on this global route. And the idea here is, well, it's fascinating to suggest this isn't your standard market correction.
Right. It's not about interest rates.
No, not interest rates, not some new geopolitical flare-up. It's a panic. A panic triggered by the realization that AI is finally doing what we've all been saying it would do for the last 3 years.
That's the beautiful irony, isn't it? For 3 years, the market has been pricing in the potential of AI. Investors were just throwing money at anything with .ai in the name. Yesterday, the market started pricing in the reality. And it turns out the reality is, well, it's deflationary for a lot of huge established companies.
Okay, so let's start with the damage report. Just to set the scale of what we're actually dealing with here. This kicked off Thursday in the US, and then like a tsunami just rolled across the globe on Friday.
The epicenter was the NASDAQ. It dropped 2% in a single session. Now, I know some of you might hear 2% and think, well,
That's just a bad Tuesday.
Right.
Markets go up and down.
exactly. But you have to look at who was selling and what was being sold. This wasn't some broad sell-off. This was a targeted liquidation of software and technology stocks.
And that fear just jumped the Pacific almost immediately. Japan's Nikkei, down 1.2%, Hong Kong down 1.7%. But the specific casualties, that's what tells the real story. We saw Apple shed 5% of its value in one day.
5%. For Apple, that's roughly $200 billion in market cap.
It just vaporized.
And just to put that number, that $200 billion, in perspective for everyone, that's the entire GDP of a mid-sized European country. Gone. In 6.5 hours of trading. That is not retail investors panicking. That's institutional money pension funds, sovereign wealth funds, reallocating capital at incredible speed.
Okay, but Apple is the headline because of its size. The company I want to focus on is one called AppLovin. They dropped 18.7%. And here's the part that, to me, signals a totally broken market psychology. AppLovin actually beat their earnings expectations. They made more money than anyone thought they would.
And this is the absolute key insight. If you want to understand this crash, you have to get this. In a normal market, you beat earnings, your stock goes up. It's a simple reward mechanism. But right now, we are seeing this complete disconnect between current earnings and terminal value.
Terminal value. Okay, let's unpack that term a little. It sounds almost like a medical diagnosis.
Hey, it kind of is for some of these companies. In finance, it just means, what is this company worth, say, 10 years from now? So investors looked at AppLovin's good numbers for today and basically said, we don't care about what you made yesterday. We don't think your entire business model even survives the next 3 years.
That is a terrifying shift in thinking. It's like the Kodak moment, but applied to the entire software sector. And the Colt report points to a very, very specific catalyst for this sudden change in mood. It wasn't just some vague anxiety. It was a product release from Anthropic.
Yes, Claude Cowork.
It sounds so friendly, doesn't it? Like a little digital colleague who brings you a virtual coffee.
The branding is friendly, sure. But the capabilities are what completely spooked the institutional money. This isn't just another chatbot that writes poems or summarizes your emails. This is what we call an agentic tool. It's designed specifically to automate these complex multi-step workflows in sales, in finance, even in legal departments.
And this is where we have to get a little technical to really get the economics of it. Why does a tool that helps with sales and finance cause a crash in software stocks? If I'm a company, isn't a better tool a good thing?
It's a great thing for the company using the tool. It is an absolute disaster for the company selling the old software. Think about the last decade of tech investing. It was all about B2B SaaS software as a service. Your Salesforce, your Workday, ServiceNow. How do they all make money?
They sell seats, right. So if I have a sales team of 50 people, I buy 50 licenses. If I grow to 100 people...
You buy 100 licenses. Exactly.
Yeah.
The per-seat pricing model. It's the holy grail of recurring revenue. It's predictable, it scales. But a tool like Claude Cowork is designed to reduce the number of humans you need to do the job in the first place. So if one AI agent can automate the work of 3 junior finance analysts, the CFO isn't going to buy licenses for those 3 humans. They're going to buy one API key for the AI.
Wow. So the whole revenue correlation it breaks. In the old world, a company grows, they hire more people, they buy more software seats from you. In this new world, a company can grow its revenue without adding headcount.
And if you're a software company whose entire valuation is based on selling more of those seats every single quarter, which implies more humans sitting at desks, that is an existential threat. The market looked at Claude Cowork and had this collective realization, wait a minute, the total addressable market for human seats just shrank.
So it's not just that the pie isn't growing anymore, the pie might actually be getting smaller.
Precisely. And that forces a complete repricing of every single stock that relies on that seat-based model.
Okay, that explains the US tech route perfectly, but the report highlights that the pain was actually more acute, more concentrated in India. And this feels like the other side of the exact same coin.
It is the exact same dynamic, just applied to services instead of software. The Indian IT sector took a massive, massive hit. The Nifty IT index was down nearly 5% in early trading.
And the names here are the absolute titans of the industry. Infosys down 6.2%, Wipro down 3.7%, and Tata Consultancy Services, TCS, fell almost 5%.
And that TCS drop is really significant. They hit a new 52-week low. Their market cap dropped below 10 lakh crore rupees for the first time since 2020. You're talking about wiping out nearly 6 years of value accumulation in a matter of days.
Why is India taking this so much harder than the US? Is it just because their market is so tech-heavy?
It's because of the business model. It's a structural thing. For 30 years, the value proposition of Indian IT has been what we call labor arbitrage. The pitch has always been, we have smart, educated people who can do this work cheaper than your people in New York or London. It's a time and materials model. You are literally billing for the hours people spend working.
So you're selling the effort, not just the outcome. You're selling the man-hours.
Precisely. But Vinod Nair from Geogen Investments had this brutal quote in the report. He called it a structural shift. He said AI is shortening lead times.
Shortening lead times. Let's translate that out of finance speak and into business reality.
It means the work gets done faster, much, much faster. And if you are billing by the hour and an AI allows that task to be done in seconds, your billable hours go to 0.
So if I'm a client in New York and I used to pay TCS to have a team of 10 people process my accounts receivable, and now I can just have an internal AI agent do it for practically nothing.
You stop the contract. Or, best case, you keep the contract, but you demand a 90% price cut because you know the vendor is just using AI to do it anyway. That is what the market is pricing in right now. They're looking at these huge Indian IT firms, which employ millions of people, and they're asking, what happens when the client stops paying for the effort?
It seems like we're moving from a rent-ahead economy to a rent-an-agent economy. And the scary part for these companies is that software is infinitely cheaper than even the most efficient human labor.
That's the arbitrage floor. You can't outprice a GPU. You can pay people very little, but you can't pay them less than the cost of electricity.
Okay, so we've got the SaaS model under fire in the US, the outsourcing model under fire in India. But here is the paradox that I'm really struggling with. The report mentions that 2026 is supposed to be this pivotal year for AI investment.
Oh, it's huge. The forecast is that big tech will spend $650 billion in CapEx, that's capital expenditures, this year alone on AI infrastructure.
650 billion. I mean, that number is just astronomical. We're talking about data centers, energy, chips. That's more than the defense budget of most nations.
It's the biggest infrastructure build-out since the internet itself, maybe even bigger.
But here's the friction point. These very companies, Microsoft, Google, Amazon, they are spending this money to build the very tools that are causing the crash we're describing. They are building the executioners of their customers' old business models.
That is the innovator's dilemma on steroids. To justify spending $650 billion, they have to produce technology that is incredibly disruptive. They have to show a return on that investment.
Right.
And the only way you get a return on that kind of capital is to automate massive chunks of the economy.
So if they succeed, they destroy the seat-based revenue models of their own customers. And if they fail, they just wasted $500 billion.
Exactly. And investors are trapped right in the middle of this logic puzzle. Ed Yardeni, who's a legend in market research, he put it really well in the report. He said investors are now focused on the disruptive characteristics. They aren't looking at the productivity gains yet. They are looking at who gets hurt first.
It feels like the market is finally admitting that efficiency is just a nice corporate word for spending less money. And one company's spending less is another company's revenue collapse.
That is the zero-sum game of this phase of AI. We are exiting the pilot phase, where everyone was just testing things, playing with image generators, having fun. We're now entering the deployment phase. And deployment means integrating these tools into the P&L. And when you do that, you cut costs.
I want to go back to the investor psychology for just a second. You mentioned that the AI premium is turning into an AI discount. Can you expand on that? Because for the last 2 years, you just put AI in your earnings call and your stock would pop. It was like a magic word.
That narrative has flipped 180 degrees completely. Now, if you're a company that does back office processing or legal document review or even basic coding, and you mention AI, investors don't hear opportunity. They hear obsolescence.
Yeah.
They hear your margins are about to get absolutely crushed by a competitor who's using a model that costs pennies.
It's guilty until proven innocent.
Look at Cisco, down 11%. Cisco is the plumbing of the internet. You'd think they'd be safe, right? But the market is now worried that AI makes network management so efficient that you sell less hardware, or that the shift to the cloud accelerates so fast that all that on-premise gear just becomes dinosaur tech. No one is safe from this narrative right now.
And looking at the immediate future, the report mentioned everyone was watching the inflation data. Why does inflation matter in the middle of a tech panic? Why isn't this just a tech story?
Because the central banks are the only safety net left. If this sell-off gets worse, normally the Federal Reserve would step in and cut interest rates to calm things down. Cheap money fixes a lot of problems. But if inflation is still hot, meaning, prices for gas and groceries are still going up, the Fed can't cut rates.
So if inflation is high, the Fed has its hands tied and the market just has to fall without a parachute.
Exactly. And we're seeing this anxiety in the year-to-date numbers. The Nifty IT index in India is already down over 11.5% since January 1st. This isn't just a Valentine's Day massacre. This has been a slow bleed that just turned into a hemorrhage.
It is a sobering reality check. I mean, we spent so much time asking, can AI write a poem?
Yeah.
Or can AI make a funny video? We didn't spend enough time asking, what happens to the profit and loss statement of a Fortune 500 company when they don't need their junior staff anymore?
And we are finding out the answer now. The answer is volatility. And it's a complete re-rating of what growth actually looks like. Is growth adding more people, or is growth doing more with less?
That distinction is just crucial. Doing more with less is great for your margins eventually, but it's terrible for your revenue growth if your whole business model depends on doing more with more people.
Right. And that's why we're seeing this great split in the market. The companies building the AI, your chip makers, your model builders, they're seeing volatility. But the companies selling the labor or selling the seats are seeing capitulation.
So just to recap for everyone trying to make sense of this chaos, this is not just a bad day of trading. This is the market fundamentally reevaluating the value of human labor in the white-collar sector.
Yes. It is the realization that the seat-based economy and the time-based economy are being directly challenged by the new outcome-based AI economy.
And with $650 billion being poured into making that AI even smarter and faster this year, the pressure is only going to increase.
The technology is accelerating, which means the disruption is accelerating. The stock market is just the scoreboard showing us who's winning and who's losing that transition.
Yeah.
And right now, the scoreboard says the old models are losing badly.
It really does challenge that fundamental assumption of modern economics, that better technology always leads to more jobs and more growth down the line.
Well, in the long run, historically, that has been true. We moved from farms to factories to offices. But as Keynes famously said, in the long run, we are all dead. The transition period, the short to medium run, can be incredibly painful for the incumbents. And we are squarely in that transition period right now.
I want to leave you with a thought to chew on this weekend. We're all kind of rooting for AI to solve cancer, to solve climate change, to make our lives easier. But if the stock market crashes every time AI gets too good at doing our jobs, we are in for a very, very strange relationship with progress.
It's the ultimate conflict of interest. Your portfolio wants stability, but the technology demands disruption.
Are we rooting for the machine, or are we rooting for the status quo? I really don't think we can have both. Thanks for joining us on this deep dive. Keep your eyes on the charts, but maybe take a break this weekend.